let's talk about these super long, kind of confusing names you see on financial products. Ever look at one and just think, what on earth is that? Well, today, we're going to take this one apart and figure it all out.
I mean, look at that name. It is a mouthful, right? Now, these names are supposed to tell you everything, but honestly, they can feel like a secret code. So let's get our decoder rings out and crack this thing. So, how are we going to do that? Simple. We're going to pull it apart, word by word, piece by piece. By the end, you'll know exactly what this is, and, maybe even more importantly, who it's actually built for. Okay, here's the game plan. First, what is this thing? Then, who's it for? We'll look at how it invests, check out the costs, and wrap up with the key takeaways. Super simple. All right, let's jump right in. First things first, we gotta tackle the jargon. It's all right there in the name. Once we get these key terms down, I promise the rest is gonna click into place.
Okay, first up is FOF. That stands for Fund of Funds. And honestly, the best way to think about it is like one of those meal kit delivery boxes. You're not buying individual vegetables or spices, stocks or bonds. You're buying a prepackaged box that already has a bunch of other funds inside. It's a really easy way to get diversified, but, and this is important, we'll talk later about how that can affect the cost. Next, we've got passive debt schemes. The keyword here is passive. This isn't about some genius fund manager trying to pick the next big winner in the bond market. Nope, it's way simpler. The goal here is just to track or mirror a specific debt index. It's on autopilot, basically.
And the last piece of the puzzle, arbitrage funds. Okay, this part is pretty cool. Arbitrage is all about finding tiny little price differences for the exact same thing in two different places, and then profiting from that difference. It's like finding a small glitch in the market and using it to your advantage. A really interesting way to try and generate returns. Okay, so we've cracked the code on the name. We know what this thing is. Now, the big question is, who is this actually for? Who's the ideal person for this kind of investment? Well, the fund document itself gives us a pretty clear answer. It says this is for people who are looking to invest for the medium term. So not a quick flip, but not a 30-year retirement plan either. And crucially, it's for someone who specifically wants this combination of passive debt and arbitrage strategies. And I love this part. They give you this handy little risk-o-meter. It's a super simple visual way to see how risky the fund is supposed to be. And for this one, it's sitting right there in the low to moderate camp. So it's not aiming to be a super high risk, high reward kind of thing. All right, we know the what and the who. Now let's pop the hood and look at the how. How does this fund actually put your money to work? This table right here is basically the fund's rulebook. Look at that top line. 95 to 100% of the money goes into, you guessed it, other mutual funds. And then it breaks it down even further, showing you the mix they're aiming for between the passive debt funds and the arbitrage funds. It's all laid out. And if you're a visual person, this donut chart makes it crystal clear. The huge chunk, at least 95%, is invested in other funds. That little sliver, up to 5%, is in what's called money market instruments. You can just think of that as cash on hand. It's there for liquidity, so if a bunch of people want to sell, they have the cash ready without having to mess with the main investments. Now, this is a really, really important point because it directly affects how much money you make. There are two ways to buy in, the regular plan and the direct plan. Think of regular as going through a middleman, an advisor or distributor, and that usually costs you more in fees. Direct is you going straight to the source, cutting out the middleman. And yep, that almost always means lower fees and better returns for you. Okay, let's get down to brass tacks. Time to talk about the numbers that really matter. How much does it cost, and how much do you need to get in the game? And here's some fantastic news right off the bat. The entry load, 0. Nothing. Zilch. That means you don't have to pay a fee just for the privilege of investing your money. That's a huge win. And it gets better. The exit load is also 0. So if you decide you want to take your money out, they're not going to hit you with a fee on the way out the door. That gives you a ton of flexibility. So what's the catch? How much do you need to start? Get this, just 100 rupees. That's it. They've made it so pretty much anyone can get started, which is awesome to see. Okay, we're in the home stretch now. Let's pull everything we've learned together and hit the highlights one more time. Whenever a new fund like this launches, there's a special window to get in early. It's called the New Fund Offer, or NFO. You can see the specific dates for this one here, when it opens, when it closes, and when it'll be available for regular trading. Just a little peek behind the curtain of a fund launch.
So let's recap the big points. What is this fund? Number one, it's a fund of funds, so it invests in other funds. Number two, it's a mix of passive debt and arbitrage. Three, the risk level is officially low to moderate. Four, and this is huge, no entry or exit fees. And five, you can start with just 100 rupees. That's the whole story in a nutshell. But wait, there's one more thing we need to talk about when it comes to costs. It's a little detail, but it's super important. Because this is a fund of funds, you're actually paying fees on two levels. You pay the fee for this fund, and you're also paying a piece of the fees for all the other funds it owns. It's like a fee within a fee. It's not a secret, but it's definitely something you need to know about. And that really leads us to the final big question. And this isn't for me to answer, it's for you. Now that you know what's going on under the hood, does this blend make sense for your goals? Is mixing that steady, predictable passive debt with the clever, opportunistic arbitrage strategy the right kind of recipe for what you're trying to achieve? That's the real takeaway here.